All right, good afternoon, everyone. It's officially noon. Welcome to this month's September second Wednesday afternoon break with Foster Swift. I'm attorney Mike Zahrt. I'm in our firm's employer services and workers' comp defense practice groups. And for those of you who are new here, we host this webinar on the second Wednesday of each month, and we interview other Foster Swift attorneys about important and relevant topics in the law. And today I'll be interviewing my colleague Mike Zahrt. Mike is a partner at our firm in our Grand Rapids office. He's experienced in business law, tax law, estate planning law, and he's really just a trusted advisor and counselor to his clients. Today's topic is on a bill recently passed into law at the federal level. It's commonly known as the One Big Beautiful Bill, and once it became law, signed into law by President Donald Trump on July 4th of 2025, this bill became known as the One Big Beautiful Bill Act. The bill contains a host of tax and spending policies that are at the center of the president's agenda. But my conversation today with Mike is going to revolve around only one aspect of this new law, essentially how it affects estate planning and succession. Ultimately, what it means for individuals and business owners. And with that short background out of the way, I want to welcome Mike Zahrt here. And Mike, you ready for the first question here?
Yeah, thank you, Mike.
Yeah. All right. So, what is the One Big Beautiful Bill Act? I understand there's some sort of relation to the Tax Cuts and Jobs Act from the prior Trump administration. So, can you explain all this?
Certainly. Yeah, the One Big Beautiful Bill Act is a budget reconciliation bill, as was the Tax Cuts and Jobs Act. Both of them are enormous. I think the One Big Beautiful Bill came in just north of 1,100 pages. Almost 300 of those relate just to the tax code. So there are a lot of tax changes. There's a lot of good resources on our website for how does the One Big Beautiful Bill impact individual taxpayers, impact business taxpayers. Those are all on the income tax side and are a little outside the scope of what we're talking about today. So today we're primarily focused on estate tax changes and how that feeds into succession planning, estate tax planning. And I think the thing to keep in mind here, if we have one takeaway, it's that between the first Trump administration, the Biden administration, the second Trump administration, we've had a lot of back and forth in the tax code. There's been a lot of flux and a lot of kind of wait and see planning for a lot of our business owner clients. And what the One Big Beautiful Bill does, at least from an estate tax side, is give us some permanence so you can feel comfortable moving ahead with your planning without all the wait and see stuff. It's important to understand that budget reconciliation bills are reconciliation bills, meaning it can pass by a simple majority in Congress. It can get around the filibuster rules. But the rub of that is that you only get one a year, and they're really only effective when one political party controls both chambers of the House and the White House. We saw that with the first Trump administration with the Tax Cuts and Jobs Act. We saw it with the Biden administration with Build Back Better, which didn't ultimately pass. And now we see it again here with the One Big Beautiful Bill. And with midterms, pretty much looming as soon as you have a presidential election, you really only get two bites at the apple for these reconciliation bills before you're worried about giving control up over one of the two chambers at midterms. So the Trump administration got it done. It was close. But the big takeaway here is that we have some permanence. And specifically, we're talking about the lifetime estate and gift tax exclusion amount. So if you think back to the Obama administration, we had essentially an allowance of about $5 million. Each taxpayer could die with $5 million worth of net worth before they would be subject to estate tax. You can share your spouses. So in the Obama days, you're talking about, $10 million, a little higher before you're subject to estate tax. The Tax Cuts and Jobs Act doubled that. So you're looking at, $20 million before you're subject to estate tax. And it indexes for inflation and all these nice things. But the way the budget reconciliation bills work is that you can't increase the federal deficit after 10 years from the passage of the bill. And that's what the Tax Cuts and Jobs Act did for a whole lot of things. So if you look at that piece of legislation, you've got a predominantly red bill with these kind of streaks of blue in it that are intended to pass budget analysis. One of those things was a sunset on the doubled estate and gift tax exclusion amount. So they said, hey, you've got this doubled allowance, but at the end of 2025, it's going to sunset and it's going to revert back to what it was pre-Tax Cuts and Jobs Act. So the one big beautiful bill comes along and says, okay, we're going to get rid of that sunset. We're actually going to make it $15 million per taxpayer, and we're going to make that permanent, which is great. So now if you're a small business owner, you're kind of looking at it going into 25 saying, okay, I don't currently have a taxable estate, but if it sunsets, I may have a taxable estate. Do I plan for estate taxes? Do I plan for income taxes? And the nice part about the one big beautiful bill is now you can kind of take that sigh of relief. You can take a breath and know if I don't have a net worth of over $30 million, I don't have a taxable estate. So that's, for today, that's the big picture. If you've been doing the wait and see and you're south of 30, deep breath, no taxable estate.
Got it. Okay, so this one big beautiful bill, it kind of makes some permanence for us. It sets this exclusion in concrete and stone. How does this permanent increase to the exclusion impact business owners specifically?
Yeah, and when I'm meeting with my closely held business owners and talking about tax planning, we kind of start by categorizing them into one of three buckets. You either have a net worth that is less than one exclusion amount, less than $15 million in 2026. You're in a tweener, right? You're north of 15 million, you're south of 30 million, recognizing that's a big window. And then the third category is our, kind of ultra high net worth clients with a gross estate, a net worth of more than two exclusion amounts. So north of $30 million. So it really depends on which of those categories you fall into. And that'll determine how this acts and impacts you.
Okay, so for the first category, um, business owners whose net worth is less than the first exclusion amount, how does this bill or the one big beautiful bill, how does that impact that category?
This is probably the easiest group to plan for, because if you're less than one, and we're talking current exclusion amounts, if you're less than $15 million, what that meant is even if the sunset were to have happened and the big beautiful bill never passed, it was going to revert back to Obama era levels, but indexed for inflation. And you'd probably still have close to enough net worth to cover it. So if I've got a $13 million business and the sunset were to happen, I've got enough to cover it. So the passage of the one big beautiful bill gives you headroom. You can grow your business to the moon. And you've got a little leeway before you actually have to start doing some estate tax planning, but really no change to the current estate plan if we're just looking at the true Trump bills, right? One thing that I have seen, and I don't know if it's like the post-COVID time warp or just the back and forth between administrations or whatever it is, I still see a lot of clients who have these Obama era estate plans. And again, keep in mind, pre-Tax Cuts and Jobs Act and pre-Big Beautiful Bill, we had an estate and gift tax exclusion amount that was roughly half. And that's been a political hot potato. When Bernie Sanders was talking about running for president, he wanted to knock a $5 million exclusion amount down to $1 million. So it's always a political hot potato, but those clients who have estate plans from the Obama era may have these kind of old school credit shelter trusts, marital trusts. The idea is if I own a small business, I'm married, I would have a trust, my wife would have a trust. And the old planning with the lower exclusion amounts was, well, let's just make sure we don't have any estate tax on the first death. So if I get hit by the bus, we're going to take a snapshot and say, okay, take the amount that fits my exclusion amount, and we're going to park that off to the side. No estate tax there. And then everything else, we're going to use the unlimited marital deduction on estate tax to push it over to my wife. So my wife might have some estate tax issues when she goes eventually, but at least on the death of the first spouse, no estate taxes, which was great planning back in the day. So if you've got that plan, it was probably appropriate when you had it, but there were a lot more people subject to estate taxes then than there are now. And what we're seeing is that the functionality of how you fund those two trusts, the marital trust, the credit shelter trust, whatever name you want to put on it, reverse funds it, right? So you might actually pull off my allowance, my exclusion amount, and park it off to the side when you could send it all to my wife and she's not going to have an estate tax problem because we've got this bigger exclusion amount. So that's probably what those people in this first category should look at is, do I have an estate plan from the Obama era? Is it this two trust structure? Because what you might have is kind of a double problem where I don't need two trusts. I don't need to pay to administer two trusts. I can get some efficiencies by moving to a joint trust. And then second, the funding mechanisms of those trusts might operate in a way that is not going to create the optimized income tax result. And that's, I guess, the second takeaway of today is you can't really plan for income taxes and estate taxes, right? If we hear this thing called a step up in basis, the idea is if I own stock in my closely held business and I die and it's includable in my gross estate for estate tax purposes, it gets a step up in basis. Same thing if I own Apple stock, right? If I bought Apple stock back in 1990, it's appreciated to the moon. And if I die holding that stock, it's going to get a step up in basis, meaning my descendants can sell it the next day and not pay any capital gain. It's a wonderful income tax planning tool. And if my wife survives and she holds that, I want it includable in her gross estate too. So we get a step up on my death and a step up on her death. And these older credit shelter AB trusts can sometimes sequester that off into a trust that's not going to get that second step up. And we're not doing the optimal planning for income taxes. So if you're in that first bucket, 15 million and under, and you've got the two trust arrangement, you're probably due for a checkup to see if you can be more efficient about the income tax planning.
And it sounds like there's a lot you can do to help these folks out. But what about the second group, the people with net worths between 15 million and 30 million?
This is probably the group that was most impacted, right? Because this is the group where if the sunset were allowed to happen, I'm going to go from not having an estate tax problem to having an estate tax problem. And then that turns the planning on its head, right? Because if I'm planning for income taxes and capital gain planning at the highest marginal rate at the federal level, that's 23.8% in a tax rate. If I'm subject to estate tax, now the excess over my exclusion amount is taxed at a rate of 40%. So it's a significantly higher tax rate. It's only on the excess, right? So if I have a $31 million gross estate between me and my wife, we only pay tax on the million. It's still a $400,000 tax bill. So that's where it turns the planning on its head, right? Especially if you have a closely held business that you want to pass along to your kids. There are a lot of business owners who have a high net worth because they might own a lot of real estate or they have this nicely profitable business, but they're not exactly cash rich, right? And it would really be detrimental to their kids if they have to turn around and cut the feds a check for 40% of mom and dad's net worth when they die. You might not be able to keep the wheels on the business if you've got that big one-time cash hit. So that was really the problem that these, I call them tweeners, were looking at, and that if the sunset is going to happen, it's going to happen at the end of the year. And we had to have a plan in place for that. Whereas if the big, beautiful bill comes along and does pass, now you don't have an estate tax problem anymore. And thankfully, that is what happened. So we don't have this year-end rush of, oh my goodness, we've turned our planning on its head. We've got a rush to do something. So that's the takeaway for the tweener group. If you're north of 15, if you're south of 30, you don't have to rush in to do any planning. But at the same time, there's a big difference between businesses that are worth $15 million and businesses that are worth $29 million, right? If I have a $15 million business, I've got to double it before I'm looking at any estate tax liability. If I have a $29 million business, and some of that's tied up in, even just real estate values, I would hope that your business is going to appreciate faster than the rate of inflation, right? And that's all the faster your allowance grows is just by inflation every year. So if you're sneaking up on 30, you might not have a current estate tax problem, but if you're outpacing inflation on growth, you will very soon. And there's all sorts of tools. We could talk for another half hour to an hour about all the different things that you could do to plan for that situation. And closely held business owners are in a great spot to do it. Because we go out, we get it valued. No offense, you're not Apple, so we get some valuation discounts and we can move stuff in a very tax efficient manner. So if you're sneaking up on 30, I would say you should still meet with somebody about, is there anything we can do proactively? If you're on the lower end of the spectrum, you should still consider baking in flexibility to your estate plan. So we still want to prioritize income tax planning because we don't want to prioritize estate tax planning if we're not subject to the tax. We want it in our gross estate. We want the step up so our heirs can sell it and have a minimal amount of capital gain. But we also want the flexibility to say, hey, if this thing pops, or if I get an inheritance that pushes me over to a new threshold, I want that flexibility. So there we talk about either spousal lifetime access trusts or irrevocable trusts we could use. I will sometimes use disclaimer trusts for married couples, and those are nice because they're revocable and give us some flexibility. There's a lot of kind of alphabet soup when we get into this type of planning for abbreviations on certain types of trusts. But for today, it's helpful to know that you can kind of have your cake and eat it too if you're a tweener, where we want to maximize the income tax planning, but still make sure we have the flexibility if you do have an estate tax problem someday.
All right, got it. So you talked about the first category, those south of 15 million. We've talked about the tweeners. What about this last category?
Yeah, if you're north of 30, you had an estate tax problem before the one big beautiful bill. You were going to have a huge estate tax problem if it didn't pass, and you still have an estate tax problem if it did pass. And if you're in this group, I would hope your advisor and your accountants are talking to you about this planning already. Because again, especially if the value is tied to a closely held business and the predominant chunk of your net worth is tied to your business, and if you want that business to continue for your kids, you probably don't have the cash to cut the federal government a check for 40% of your net worth, right? Well, the portion that exceeds the exclusion amount. And here things get very complex. There's an incredible amount of nuance. I think just a couple of takeaways for today is that for closely held business owners, you're in a perfect spot to do this type of planning for the leverage we mentioned earlier. So if we want to move something to an irrevocable trust, so it's outside of your gross estate for estate tax purposes, we have to tell the IRS what's that worth. We're going to file a gift tax return. It's going to use up some of that lifetime allowance. So if I've got a big business and I say, you know what, I'm going to gift $1 million worth of stock into a gift trust for my kids, that's going to lower my lifetime exclusion amount. And I have to file a gift tax return to tell the IRS how much did I lower it by. Well, we're going to hire somebody and they're going to come in and say, hey, it's not Apple stock discount. You're only transferring $1 million of the 30 million. It's not a controlling interest discount. And at the end of the day, you might have discounts of 30%, which allows me to say, okay, I'm going to take $1 million off your balance sheet. But when I report it to the service, I'm only going to report it as a $700,000 gift. I save you, $300,000 in immediate leverage at a 40% estate tax rate. And all of a sudden we're talking real dollars. The bigger value, if you see the business growing and you want it to continue growing and stay in the family for successive generations, is the value of freezing it, right? So as soon as we transfer it into an irrevocable trust that's outside of your gross estate, we've frozen the value of that equity interest. And even though the business continues to appreciate, that appreciation is going to be outside of your gross estate. And if we structure the trust correctly, it's not in your kid's gross estate, your grandkids' gross estate. So we don't solve an estate tax problem by just pushing it off to successive generations. We put you in the position of saying, hey, if this is a generational business, we don't want to have to keep solving this problem at every generation. Let's solve it once, solve it right, and now you can just focus on the business again. And there's all sorts of ways to do that. And again, this is the alphabet soup, right? So we have spousal lifetime access trusts. Those are SLATs. Intentionally defective grantor trusts. Those are IDITs or IDITs, and sometimes you're called. You have grantor retained annuity trusts. Those are GRATs. And there's CRATs and CLATs and sales with self-canceling installment notes. And those are skins. And, tax code at lunchtime, we don't want to put people to sleep, but just know if you're north of 30, there are no shortage of tools. And that's part of what I think we do particularly well in this office is not just a one size fits all for those ultra high net folks. It's a family by family, business by business determination. And we can typically structure a plan that not only allows the current generation to absolutely maintain ironclad control over the day-to-day management aspects of the business, but also solve their estate tax concerns. And I think that's important to keep in mind too, is that you hear about putting stuff off into irrevocable trusts and these sorts of things. And I have a lot of clients say, I don't want to retire yet. And you don't have to. We'll make voting stock and non-voting stock, and you can run it until you want to be done running it, but not create a bigger estate tax problem too. So that's probably a topic for a whole nother second Wednesday, but no shortage of complex planning if you're north of 30.
Oh yeah. It seems like the one big beautiful bill Act, it's really impacted owners of, almost all businesses. Is that correct?
Yeah, I mean, I think the only category that may not have to worry about this is if your business is less than say 5 million bucks. Which is not to belittle anyone with a business of that size. That's still a nice size business, but from a tax planning perspective, an estate tax planning perspective, you didn't have a problem during the Obama administration. You're not going to have a problem now, and that probably means that even if you have an Obama era estate plan, it's probably not with that problematic two trust funding formula we talked about earlier, where you might not have an estate tax problem, but you're not being maximally efficient on the income tax planning either. So if you're south of 5 million, you're probably good. I mean, still take a look at your estate plan. If it's from the early 90s, maybe you're not. So I know we want to save some time for questions here. I think if we want to break it down, net worth below 5, probably fine. Take a look at your estate plan anyway. You should be looking at that. I tell my clients every presidential cycle, not just because there's political stuff that impacts it, but 4 years is just enough time where stuff happens and you should dust it off and look at it. If you are less than one exclusion amount, right? 15 million and under, that's where you really need to look at your planning. If it's, Obama era or prior, you might have inefficient trust funding formulas, and we can do better on an income tax planning side for you. If you fall into that category, but no estate tax issue. If you're a tweener, then it's really a sliding scale. If you're closer to the 15, you've got the same issue as the 15 and under, making sure that your estate plan is prioritizing income tax planning and just how we structure trust provisions over estate tax planning. The closer you get to that $30 million number, now the more attention we've kind of got to pay to estate tax planning and make sure we build in the flexibility to prioritize income tax planning until we have an estate tax problem. And then we need the flexibility to flip it, right? And then north of 30, you probably have to be prioritizing estate tax planning just because it's such a higher tax rate than the income tax planning. And that again is where you really, when you start moving stuff into irrevocable trust so you don't own it anymore for estate tax planning purposes, we have to be really careful to make sure that we're accomplishing the business goals, we're accomplishing the tax goals, the family goals. Do you have kids in and outside of the family business? What's fair, what's equal? All those conversations that take place in any business succession context really get magnified when you're also kind of handcuffed by the tax rules.
Thanks for the expertise, Mike. And, thanks for breaking it down too in terms of these three different buckets that we have to look at. I really appreciate your time today. I didn't mention at the beginning, if there's any questions, you can put them in the chat here, but we've also included Mike's contact information below. If you're thinking you might want to run a question by him, feel free to reach out to him. He's happy to help. In fact, he's helped a couple of my clients recently with some of their needs. So they've been very appreciative. Thanks for that, Mike. And thanks for your time. We'll be back in 1 month. Second Wednesday of October, we're coming back. We'll be back right here on Zoom. And thanks for your time today, everyone. Take care.
Thank you.